How a stock dividend works. Also known as a scrip dividend, a stock dividend is a distribution of shares to existing shareholders instead of a cash dividend. This type of dividend may be made when a company wants to reward its investors but doesn't have spare cash or chooses to preserve cash for other investments. Stock dividends have a tax advantage for the investor. The share dividend, like any stock share, is not taxed until the investor sells it. The board of a public company may approve a 5% stock dividend. That gives existing investors an additional share of company stock for every 20 shares they already own. However, this means that the pool of available stock shares in the company increases by 5%, diluting the value of existing shares. Therefore, an investor who owned 100 shares in a company will own 105 shares once the dividend is executed, but the total market value of those shares remains the same. In this way, a stock dividend is similar to a stock split. When a stock dividend is issued, the total value of equity remains the same from both the investor's perspective and the company's perspective. All stock dividends require an accounting journal entry for the company issuing the dividend. This entry transfers the value of the issued stock from the retained earnings account to the paid-in capital account. Small stock dividend. A stock dividend is considered small if the shares issued are less than 25% of the total value of shares outstanding before the dividend. A journal entry for a small stock dividend transfers the market value of the issued shares from retained earnings to paid-in capital. Company X declares a 10% stock dividend on its 500,000 shares of common stock. Its common stock has a par value of $1 per share and a market price of $5 per share. When the small stock dividend is declared, the market price of $5 per share is used to assign the value to the dividend as $250,000, 500,000 by 10% x $5. The common stock dividend distributable is $50,000, 500,000 by 10% x $1, since the common stock has a par value of $1 per share. Large stock dividend. Large stock dividends are those in which the new shares issued are more than 25% of the value of the total shares outstanding before the dividend. In this case, the journal entry transfers the par value of the issued shares from retained earnings to paid-in capital. If Company X declares a 30% stock dividend instead of 10%, the value assigned to the dividend would be the par value of $1 per share, as it is considered a large stock dividend, and would make the following journal entry of $150,000, 500,000 by 30% x $1, by using the par value, instead of the market price. What is an example of a stock dividend? If a company issues a 5% stock dividend, it would increase the number of shares held by shareholders by 5%, or 1 share for every 20 owned. If there are 1 million shares in a company, this would translate into an additional 50,000 shares. A shareholder with 100 shares in the company would receive 5 additional shares. Unlike a cash dividend, a stock dividend does not increase the value of the company. If the company was priced at $10 per share, the value of the company would be $10 million. After the stock dividend, the value will remain the same, but the share price will decrease to $9.50 to adjust for the dividend payout. Why do companies issue stock dividends? A company may issue a stock dividend if it has a limited supply of liquid cash reserves. It may also choose to issue a stock dividend if it is trying to preserve its existing supply of cash. While issuing a stock dividend essentially dilutes the value of the outstanding shares because it increases the total supply of stock, if the shares were to rise in price, this can be advantageous for the shareholders. What is the difference between a stock dividend and a cash dividend? While a stock dividend is paid out in the form of company shares, a cash dividend is paid out as cash. A company that has a 7% annual stock dividend would entitle the owner of 100 shares to 7 additional shares. Conversely, consider a company that issues a 70 cents annual cash dividend per share, which in turn would entitle the owner of 100 shares to a total value of $70 in dividends annually. The bottom line. A stock dividend is a dividend payment to shareholders that is made in shares instead of cash. The stock dividend rewards shareholders without reducing the company's cash balance, although it can dilute earnings per share. Stock dividends, as opposed to cash dividends, may signal financial instability and limited cash reserves. Stock dividends are not taxed for the investor until they are sold. Win up to $10,000 while trading digital assets. Digital asset trading just got easier. With OKX, a leading digital asset financial service provider, you can access world-class security as you trade and store assets. What's more, you can win a mystery box worth up to $10,000 when you complete a deposit of more than $50 through a crypto purchase or top up within 30 days of registration. Learn more and sign up to claim your mystery box today. Market signaling and asymmetric information. The market may perceive a stock dividend as a shortage of cash, signaling financial problems. Market participants may believe the company is financially distressed, as they do not know the actual reason for management issuing a stock dividend. This can put selling pressure on the stock and depress its price. Risky projects. Issuing a stock dividend instead of a cash dividend may signal that the company is using its cash to invest in risky projects. The practice can cast doubt on the company's management and subsequently depress its stock price. Journal entries for a stock dividend. The journal entries for a stock dividend depends on whether the company is involved in a small stock dividend or a large stock dividend. The journal entries for both sizes are illustrated below. Small dividend. A stock dividend is considered a small stock dividend if the number of shares being issued is less than 25%. For example, assume a company holds 5,000 common shares outstanding and declares a 5% common stock dividend. In addition, the par value per stock is $1, and the market value is $10 on the declaration date. In this scenario, 5,000 by 5% equals 250 new common shares will be issued. The following entries are made. Large dividend. A stock dividend is considered a large stock dividend if the number of shares being issued is greater than 25%. For example, assume a company owns 5,000 common shares outstanding and declares a 50% common stock dividend. In addition, the par value per stock is $1, and the market value is $10 on the declaration date. In such a scenario, 5,000 by 50% equals 2,500 new common shares will be issued. The following entries are made. A company that does not have enough cash may choose to pay a stock dividend in lieu of a cash dividend. In other words, a cash dividend allows a company to maintain its current cash position. No tax considerations exist for issuing a stock dividend. For this reason, shareholders typically believe that a stock dividend is superior to a cash dividend. A cash dividend is treated as income in the year received and is, therefore, taxed. Please like, comment, share and subscribe to my channel. Thanks for watching.